Welcome to Smart Money Explained, the podcast where finance, investing, and the economy are broken down clearly and without the hype. Each episode delivers practical insights to help you make smarter financial decisions, understand what's driving the markets, and think long-term about money. If you want straightforward financial guidance you can actually use, you're in the right place.
Today, we are undertaking a massive structural engineering project.
That's a good way to put it.
We're going to tear apart the common and often, fear-driven perception of the stock market as just this giant, volatile casino. Our goal is to reveal the massive, intricate machine that's actually functioning underneath. We are going far beyond how to buy a stock to understand this entire ecosystem.
A whole thing.
From the frantic, essential human element on the trading floor all the way up to the complex global policy frameworks that hold the entire structure together.
And this really is a deep dive into architecture. Our mission is total clarity on the mechanism, the structure, and of course the underlying forces governing global finance.
And for that, we've pulled a really powerful stack of sources.
Oh yeah. We have everything from the Bureau of Economic Analysis, the Federal Reserve, the BLS, the IMF, the NBER, the World Bank, the OECD, and a really insightful look at the regulatory efforts of the SEC.
Plus the specific mechanics of the New York Stock Exchange.
We're going to show you the whole picture.
I think the best place to start is with the most fundamental question, which I feel like often gets lost in the noise of daily prices. Why do we even have these markets in the first place? What is their grand societal purpose?
The why is profoundly systemic. I mean, if we synthesize the high-level perspectives from, say, the OECD and the World Bank, the purpose of financial markets isn't primarily individual wealth generation.
That's a byproduct.
It's a byproduct. Fundamentally, it's about promoting broad, sustainable economic goals. These efficient systems are just. They're absolutely critical for financial stability.
So if we look at it through the lens of the World Bank, it's about funding things that actually matter, right? It's about taking that big pool of global capital and directing it toward productive uses.
That's the engine room of the economy. Exactly. The World Bank really emphasizes that deep, vibrant capital markets. They fund the long-term investment needed to support jobs, human capital development, and critical infrastructure projects.
Things like dams, roads.
The dams, the roads, the communication networks, all of it. When financial systems are sound and resilient, they underpin growth and, crucially, they help alleviate poverty on a global scale.
The OECD seems to expand that view a bit, looking at how well-designed markets support long-term sustainable growth. What does sustainable actually mean in this context?
Well, it means stability and structure. The OECD stresses that they have to provide the essential platform to raise and allocate capital efficiently, to manage risk.
Like through insurance and hedging.
Right, and to determine asset prices accurately and to inform investment decisions based on transparency. They explicitly connect this to promoting fairness, transparency, and, define rules of engagement.
Because without those,
you don't foster investor confidence, and the capital just stops flowing where it's needed most. It stagnates.
I really appreciate that distinction. The goal isn't just efficiency, it's trust. If capital markets are seen as being rigged, they fail in their core societal function of funding jobs and infrastructure.
Precisely. And achieving that trust requires understanding all the moving parts. It's a multi-layered cake of complexity, as you put it. So we're starting right on the trading floor to look at the micromechanics, the actual setting of prices, and then we'll pull back to the macro structures that regulate it globally before finally looking at the raw economic data that dictates the market's underlying health and value.
Okay, let's unpack this, starting with that core trading mechanism described by the New York Stock Exchange. When people picture the stock market, they often think of chaos. But the NYSE source material highlights a really unique model that intentionally resists that drive toward pure, unadulterated speed. So we're shifting our focus now from that grand global purpose to the nuts and bolts of where prices are actually discovered and transactions are completed. And the NYSE model is fascinating because its core philosophy, it kind of runs counter to the general trend in modern finance toward speed above all else.
That's the key differentiator. It really is. The NYSE explicitly prioritizes price discovery and stability over mere execution speed.
So they're not trying to be the fastest.
Not necessarily. They operate on the staunch belief that nothing can fully replace human insight and accountability in critical moments. They combine leading technology, I mean the fastest systems available, with the required oversight of human judgment. And the goal is to create a measurable, superior market quality.
What's the practical difference then between a system that prioritizes pure speed versus one that prioritizes stability? I mean, if everything is milliseconds faster somewhere else, doesn't the NYSE model sacrifice some efficiency?
Well, they would argue that what you gain in stability far outweighs any microsecond efficiency loss. Their approach, which they call high touch, is designed to result in lower volatility, deeper liquidity, and ultimately improves prices for both the buyers and sellers of the companies listed there.
Right, and lower volatility means fewer dramatic price swings from, say, a temporary panic or an algorithmic error. That's crucial for a long-term investor.
Incredibly crucial. And the centerpiece of this high-touch philosophy is a role that has existed for decades, but has, very modern obligations. The designated market maker, or DMM.
And the DMM, good.
The DMM is the cornerstone role. These aren't just floor traders. They have specific mandatory obligations enforced by the exchange to maintain fair and orderly markets for their assigned securities.
And they work in two worlds at once.
Simultaneously, they work manually on the physical floor and electronically through their own algorithmic quotes.
If they are maintaining a fair and orderly market, it sounds like they're the market's shock absorber. What are the specific circumstances where their human intervention is most critical?
That's a perfect way to describe it. Their key function is facilitating robust price discovery during periods of maximum stress or uncertainty. So think of the market open, the market close.
Right, the most volatile times.
Exactly, and any periods of significant trading imbalances, like when a huge wave of buy-or-sell orders hits the system all at once, a DMM applies their deep market experience, their instantaneous judgment of dynamic trading conditions, and they synthesize incoming information.
So like a surprise Federal Reserve announcement.
Or industry-specific intelligence, yeah. They do that to ensure the market doesn't completely fly off the rails because of fear or some kind of algorithmic feedback loop.
So they are synthesizing real-world news and policy changes, like the data we're going to discuss later from the Fed and the BLS, and translating that into immediate action on the floor instead of just executing some static algorithm.
Exactly. And they're required to provide capital commitments.
Meaning they have to put their own money on the line.
They have to step in with their own capital to buy or sell if it's necessary to stabilize the price during instability. That's how they maintain liquidity. They are the liquidity backstop. And it's critical to note that while they have these obligations, their orders are on parity with orders from all other market participants in the electronic system. This encourages their essential participation while still holding them accountable.
That dual approach, manual oversight combined with electronic speed, it shows measurable results in the source material, specifically regarding volatility reduction. Let's look at those statistics because they directly address the core concern of the average investor.
The data speaks very strongly to the goal of stability. The NYSE reports that compared to pure electronic trading models, their DMM-supported high-touch approach yields superior market quality, especially around major events. For companies newly listed, they are, get this, 30% less volatile on listing day.
30%? That's huge, especially since IPOs are inherently high-risk, speculative events.
It's massive. And they're also 23% less volatile during lockup expirations.
Okay, for a listener who might not know the term, what is a lockup expiration?
Right. A lockup expiration is the period, usually about 90 to 180 days after an IPO, where original investors and company insiders are suddenly allowed to sell their shares for the very first time.
So a flood of sell orders could hit the market.
An immense pressure, yeah. This event can just flood the market with sell orders. The DMM's presence helps absorb and stabilize that influx.
And perhaps most relevant to the daily investor's life.
Yeah.
The stability at the start and end of the day.
Absolutely essential. The data shows they are 51% less volatile at the open and 52% less volatile at the close.
52%.
And this volatility dampening at the market close is so vital for passive investors.
Why is that?
Because mutual funds and ETFs calculate their official net asset value, or NAV, the price at which you can buy or sell fund shares based on that closing price. A 52% reduction in closing volatility protects billions of dollars in passive investments from being exposed to late-day manipulation or, flash crashes.
That analysis really shows why the stability matters. It's protecting the small dollar passive investor from algorithmic spikes or, quote, stuffing at the exact moment their investment value is being calculated for the day.
It connects the micro mechanism directly to macro investor stability. But DMMs aren't the only support structure. The market needs continuous high-volume liquidity as well.
And that's where the supplemental liquidity providers, or SLPs, come in. They sound more like the pure electronic speed merchants.
Yeah. SLPs are electronic high-volume members. They're specifically incentivized, meaning they get rebates or favorable pricing structures to add liquidity to the exchange.
And they focus on the big stocks.
Yeah, they primarily focus on more liquid stocks, generally those with greater than 1 million shares of average daily volume. They're the volume drivers, but they also have obligations.
What are their obligations?
They are required to maintain a bid or an offer at the National Best Bid or Offer, or NBBO, for at least 10% of the trading day in their assigned securities.
And the NBBO. That's a really critical concept for the listener.
It is. The NBBO is the best available price, the highest bid to buy or the lowest offer to sell that's available across all exchanges nationally. This rule ensures that even the SLPs, who are focused on speed, are contributing to the national standard of best price execution, not just internal NYSE liquidity.
So the SLPs are adding volume and speed, but they're still benchmarked against that national best price standard.
Yeah.
Oh, and finally, the iconic role, the floor brokers, the people we actually see on TV.
Yes, the agents on the floor. Floor brokers are employees of member firms who execute trades as agents for their firm's institutional clients, the big hedge funds, pension funds, investment banks.
And they're physically there.
They are physically present, active participants throughout the day, and they play a crucial role in managing those massive orders and negotiating during auctions.
So we had the DMMs setting prices and maintaining order, the SLPs providing rapid electronic volume tied to the national best price, and the floor brokers executing the huge institutional orders. That gives us a truly detailed understanding of the micromechanics of how this central marketplace functions and why that human element is so intentionally kept in the loop.
We've established that the DMMs successfully handle volatility risk at the micro level. But what happens when the risk isn't just volatility, it's outright systemic fraud, or failure of disclosure, or macroeconomic instability?
Right.
That's when we pull back to the global and national regulators. If we connect this to the bigger picture, we start to see how global policy and national regulation ensure integrity and stability outside the trading mechanism itself.
We are pulling back to the watchdogs and the policymakers. At the national level for the U.S. investor, that means the Securities and Exchange Commission, or SEC, and its consumer-facing arm, investor.Gov. This is the government agency most directly responsible for investor protection.
Investor protection and education, that's the SEC's mandate. They provide extensive resources to help the public navigate markets safely, and they focus heavily on education and vigilance against fraud.
And for you, the listener, recognizing these red flags is arguably the most valuable self-protection tool available.
It really is.
So let's dedicate some time to detailing the 6 specific red flags of fraud the SEC highlights, because they are just essential knowledge for anyone looking to enter or stay in the market.
These 6 signs are used by fraudsters globally, whether they're selling a fake stock, a complex Ponzi scheme, or a risky crypto asset.
Okay, what's number 1?
First, be extremely skeptical of promises of high investment returns with little or no risk. This violates the fundamental law of finance. Risk and return are intrinsically linked. If a guaranteed return sounds too good to be true.
It is, always.
It is. Second, watch out for pressure to act now. Fraudsters weaponize urgency. This deal closes tonight, because they know if you stop to do your due diligence, you will uncover the lie.
Third is one we hear a lot about these days, fear of missing out, or FOMO.
Exactly. If you feel that emotional twitch, that little pang of anxiety, that's your brain signaling the need to step away from the keyboard and look up the investment on the SEC's public search tools.
What's the 4th?
Fourth, fake testimonials. If the person touting the investment is using generic praise, stock photos, or stories that just sound a little too perfect, be skeptical. Real investment success usually isn't advertised via unsolicited, poorly vetted claims.
Okay, number 5.
Fifth, promises of great wealth. Exaggerated or unrealistic expectations are designed to override your common sense. If the math doesn't make sense, a triple-digit return in a slow-growth sector, it's a massive warning sign.
And the final one, number 6.
And sixth, suspicious payment methods. Anything that seems unconventional or difficult to trace, like demanding payment in untraceable crypto, gift cards, or specific offshore wire transfers, should raise immediate, huge alarm bells.
Those 6 points are just a massive filter. I mean, if you apply those to every unsolicited investment opportunity you receive, you probably eliminate 99% of the junk out there.
Absolutely. And beyond just fraud warnings, investor.gov provides key educational resources for legitimate investment. They cover important topics like the crucial necessity of understanding investment fees.
Which can eat away at your returns dramatically over decades.
Dramatically. And the importance of periodically rebalancing your portfolio.
And for planning, the tools they offer are incredibly practical.
They are indispensable for long-term planning. They provide a powerful compound interest calculator to visually demonstrate how money grows exponentially over time. They have a required minimum distribution calculator, or RMD, which is essential for older investors to calculate how much they have to withdraw from retirement funds to avoid steep IRS penalties.
And the Social Security estimator.
And they featured the official Social Security retirement estimator. This whole toolkit reinforces that successful engagement with the market requires robust planning, not just trading instinct.
So the SEC handles the local oversight and individual protection. But as we noted, capital flows globally. We have to look at the powerful global structures like the OECD and the World Bank that dictate international financial standards and systemic health.
Right. The OECD works primarily with developed nations, promoting international standards to foster global markets that are fair, transparent, and efficient. Their work is multifaceted, recognizing that finance intersects with every major challenge facing societies today.
So what are the primary policy areas the OECD is focused on in finance and investment?
Well, they're busy. First, they focus heavily on financial consumer protection, education, and inclusion, supporting individual financial well-being globally. Second, they focus on financial markets themselves, creating sound policies for capital markets, encouraging sustainable finance like green bonds.
And managing the rapid growth of digital finance.
Exactly. And third, pensions and insurance are vital. They require sophisticated guidance on system design and risk management, especially as these systems face the twin challenges of population aging and massive climate-related disasters, which are increasing insured losses.
That link between climate disaster, insurance risk, and market stability is a profound connection the OECD is trying to solve.
It really shows how complex systemic risk has become. The World Bank, meanwhile, shifts the focus more toward development and building strong systems in emerging economies.
And what are the World Bank's core areas of focus for financial systems development?
Their mission is foundational to economic growth and poverty alleviation. They focus heavily on financial integrity, working to reinforce global systems against dirty money through anti-money laundering frameworks and asset recovery initiatives.
So cleaning up the system.
Cleaning up the system. They also address digital finance and fintech, not just the technology, but ensuring it expands financial access responsibly. And crucially, they focus on credit infrastructure.
Meaning what exactly?
Establishing the laws and institutions that allow businesses and people to access finance. Credit reporting systems, collateral registries, robust insolvency frameworks.
So the World Bank is literally helping countries write the legal rulebook required to make banking and lending work safely.
Precisely. And they prioritize financial stability across lower-income countries, including banking regulations, supervision, and crisis management, making sure that local bank failures don't become systemic threats that choke off economic growth.
It's clear that the global financial system is only as strong as its weakest link, and these bodies are working to fortify those links. Now, let's step back into national policy, but look at its financial impact through legislative oversight, the Congressional Budget Office, or CBO.
Right. The CBO doesn't regulate the market, but it provides the financial roadmap for every single piece of legislation the U.S. Congress considers. Their role is to provide nonpartisan cost estimates for legislative acts, demonstrating the profound financial entanglement of the market with every policy decision across every single sector.
In other words, every government action has a price tag. And the size of that price tag and how it's funded can rattle the entire financial market because it affects national debt and fiscal health.
Correct. The CBO shows the listener that the market stability is not just about financial regulation. It's about legislative discipline everywhere. The source material cites examples that illustrate this vast scope. They calculate the budgetary effects of bills ranging from the American Decade of Sports Act to the Stop Illegal Fishing Act and the Lower Healthcare Premiums for All Americans Act.
Sports, fishing, and healthcare. I mean, each of those disparate policies requires an expenditure or changes the revenue structure of the government, which impacts the national budget, which in turn influences market sentiment about long-term fiscal stability. It really is all connected under the CBO's calculation. Here's where it gets really interesting. We've talked about the exchange mechanics and the regulatory framework. Now we dive into the actual substance that drives the market, the real economy, and the powerful actions of central banks. The stock market just doesn't exist in a vacuum. It is ultimately tethered to economic reality.
The regulatory framework is meaningless if the underlying economy isn't producing value. Market health depends entirely on comprehensive, granular data points that measure national activity, the macro-level pulse. And we have two key providers for that: the Bureau of Economic Analysis, the BEA, and the Bureau of Labor Statistics, the BLS.
Let's clearly delineate their roles, because I think they're often confused. The BEA is focused on the big picture of national output, correct?
Yes, the BEA is the National Accounts Report Card. They provide the overall health metrics. Key topics include gross domestic product, GDP, which is the primary measure of economic output, consumer spending, income and saving, prices and inflation, and investment in fixed assets.
So these data points tell us how fast the economy is growing, the capacity for future growth, and whether inflation is coming from rising consumer demand.
Exactly. While the BEA gives us the overall report card, the BLS gives us the inflation and employment Seaver chart. These are the data points that the Federal Reserve watches most closely when deciding monetary policy.
Absolutely. The BLS data topics are among the most highly anticipated and market-moving releases every single month. They cover inflation and prices, specifically the Consumer Price Index, the CPI, which tracks costs for consumers, and the Producer Price Indexes, PPI, which tracks costs for businesses. They also measure the full scope of the labor market, including unemployment, national, state, and local rates, employment projections, productivity, and business employment dynamics.
Market participants use the BLS data to predict consumer health and future corporate earnings. If inflation is high, the Fed will react. If unemployment is low, that can spur inflation. The data is the fuel.
It's the input for all the valuation models. If the cost of inputs, the PPI, is rising, corporate margins are squeezed. If labor markets are tight, wage costs rise. This all directly impacts the stock prices that the DMMs are trading on the NYSE floor.
And someone has to act on all this complex data to maintain stability and meet their dual mandate. That is the Federal Reserve. Their influence is perhaps the single biggest driver of the macroeconomic environment for asset prices globally.
The Fed's mandate is explicit and powerful: to promote maximum employment, stable prices, and moderate long-term interest rates. They don't just set a single rate. They influence the entire cost of capital through a variety of tools that I think require some detailed explanation.
They really do.
So let's break down those core mechanisms, because truly understanding how the Fed works is key to understanding the underlying foundation of the stock market.
Okay, we'll cover the 5 major tools the Fed utilizes. First, and this is historically the most common, are open market operations, or FOMOs.
What are those?
This involves the buying and selling of U.S. government securities in the open market. When the Fed buys bonds, it injects reserves into the banking system, which increases liquidity and pushes down the federal funds rate.
Which is the rate banks charge each other for overnight lending.
Exactly. When they sell bonds, they drain reserves, tightening liquidity and pushing the rate up. This is their direct lever on short-term interest rates.
It's literally the action of adding or subtracting money supply from the system. What about the discount window and discount rate?
The discount window is a standing offer by the Fed to lend money directly to depository institutions. The discount rate is the interest rate charged on those loans. This acts as the lender of last resort.
So if a bank is in trouble?
If a bank is experiencing a temporary liquidity crunch, they can go to the discount window. Since the discount rate is usually set higher than the federal funds rate, borrowing here often carries a slight stigma, signaling that the bank couldn't get money cheaply elsewhere. But it's a crucial backstop for systemic stability.
Next, reserve requirements. The percentage of deposits banks must hold in reserve. This was once a primary tool, but its role has changed, hasn't it?
It has shifted dramatically. Historically, the Fed would raise or lower reserve requirements to change the amount of money banks could lend out. Today, due to the massive influx of reserves following various crises, most large banks have far more reserves than required, rendering this tool largely ineffective for daily monetary policy control.
So it's not really a lever they pull anymore.
Not in the same way, it's now technically set at zero for all banks, which signals the Fed has moved away from using it as a primary control lever.
Okay, so if reserve requirements are largely sidelined, how does the Fed actively influence the short-term rate? That brings us to interest on reserve balances, or IORB.
IORB is arguably the most powerful modern tool. The Fed pays banks interest on the money they hold on deposit at the Federal Reserve. By raising the IORB rate, the Fed incentivizes banks to hold more money at the Fed rather than lending it out cheaply.
So it sets a floor under the federal funds rate.
It sets a floor. If the Fed wants to increase the cost of money for everyone, they raise the IORB, and that pulls all short-term rates up with it. It's a subtle but immensely powerful mechanism.
And finally, the lesser-known fifth tool, the term deposit facility.
Right. This is a mechanism that allows the Fed to manage aggregate reserve balances. They offer interest-bearing term deposits to eligible institutions. It's another way for the Fed to temporarily lock up liquidity in the system, absorbing reserves when they need to tighten financial conditions without relying solely on HOMOs or IORB.
These 5 tools, combined with the Fed's massive intellectual engine, they shape the very cost of capital, determining how companies invest and how investors value them.
And their policy decisions are informed by highly specialized research, circulated through key publications like the Finance and Economics Discussion Series, FEDS Working Papers, and the International Finance Discussion Papers, IFDP Working Papers.
These aren't just simple memos, they're sophisticated economic modeling.
Absolutely. For instance, an IFDP paper might model the impact of global trade tariffs on currency flows, while a FEDS paper might analyze something like estimating data center investment and its impact on productivity.
That gives you, the listener, a tangible sense of the depth. They are modeling every single variable that feeds into the macroeconomy. Stepping out to the global academic community, we also have research centers like the IMF and the NBER, providing crucial context.
The IMF provides that crucial global context, especially for interconnected risk. They release the Global Financial Stability Report, which assesses risks to the global financial system, things like sovereign debt levels, excessive leverage and shadow banking, or the stability of emerging market capital flows.
And they look at the big modern challenges.
They do. They also research massive cross-border topics like the fiscal policy needed to adapt to climate change and the systemic risks posed by unregulated fintech.
And the NBER, the National Bureau of Economic Research, acts as the leading circulation point for academic thinking, often before it's even peer-reviewed and published in formal journals. This is where the newest intellectual theories about market structure and valuation begin.
The NBER circulates over 1,200 working papers each year. They are the initial testing ground for cutting-edge economic theories that will inform policy and market analysis years down the line. Their key working groups relevant to the market include asset pricing.
How things are valued.
Exactly. Corporate finance, which is how firms raise and allocate capital. Monetary economics, the impact of central banking. And the extremely insightful field of behavioral finance, which studies investor psychology, the irrational human element that can often override the stable mechanisms we just discussed.
So if you want to know what the academic community is thinking about the future of, say, the DMM role in the NYSE floor, you might find the initial theory in an NBER working paper today. It's the intellectual fuel for the entire financial engine.
We have successfully spanned the entire market ecosystem, from the micro-auction floor, stabilized by human judgment, to the macroeconomic data that determines value, and the central bank policy that maintains the foundation. It's time to synthesize these layers and bring it back home to the individual learner.
The power of this deep dive is truly in connecting the dots between those 3 major layers: the physical mechanism, the global regulatory shield, and the economic undercurrents. We really need to see how they rely on each other.
For instance, the efficiency of capital allocation, a core societal goal cited by the World Bank and the OECD for funding infrastructure and jobs, is fundamentally reliant on the stability offered by the NYSE's DMM and human insight model. If the market is characterized by wild, unpredictable swings, capital becomes risk-averse. It won't flow efficiently into the productive long-term investments that need it most. Stability is productive.
And the intrinsic value of any specific investment, the stock price, which is the subject of that NYSE auction, is fundamentally connected to broad economic health data. If the BEA's GDP figures are weak, if the BLS's employment data suggests recession, even a perfectly regulated company will struggle for valuation stability.
Absolutely. As the NBER's asset pricing group confirms, valuation ultimately comes down to expected future cash flows, which are tied directly to the health of the macroeconomy.
Exactly, and the entire system relies on the predictable foundation delivered by the Federal Reserve's monetary policy. Stable prices and moderate long-term interest rates are the bedrock upon which all asset prices, all corporate investment decisions, and all individual retirement plans are built. When the Fed moves, everyone moves. So, after seeing this robust, complex, and highly regulated machinery underneath the surface, what is the ultimate responsibility of the investor? Because the system is designed to protect them, but it's not foolproof.
Well, the ultimate responsibility lies with the individual to remain informed, to utilize the free tools provided by regulators like investor.Gov, and to remain highly vigilant against attempts to exploit the system for fraud.
Let's review those 6 red flags of fraud from the SEC one final time, framing them as your primary defense mechanism against illicit activity.
Be skeptical of any pitch that removes the need for trade-offs. Promises of high investment returns with little or no risk.
Never succumb to the urgency of pressure to act now. Just take a day to think about it.
Recognize the psychological trigger of the fear of missing out, or FOMO, and use it as a signal to exercise caution.
And don't base your decisions solely on generic or fake testimonials. Trust verified information.
Be wary of any offer that gives you promises of great wealth that defy rational economic models.
And instantly disconnect from any investment pitch that requires suspicious payment methods.
This deep dive has shown that the stock market is less about instinct and random chance and more about engineering, data, and deliberate, layered regulation. It's a massive structure designed, however imperfectly, to allocate resources efficiently across the globe while providing necessary stability.
It is an incredible piece of economic infrastructure, but that leads directly into the core tension we've seen reflected throughout our source material, especially concerning the future.
That tension is reflected between the physical, human-centric systems like the NYSE DMMs dampening volatility through manual intervention, and the rapid, borderless evolution of digital finance and fintech, which the World Bank and IMF are so heavily focused on regulating.
We have human judgment trying to keep a lid on stability in a world increasingly dominated by algorithmic, split-second trading, the rise of AI-driven strategies, and novel digital assets that trade 24/7 globally.
So the question for you, the learner, to consider as you navigate this market is precisely this. How long can human judgment remain the primary dampener of volatility in an increasingly automated and digitally integrated global market? As capital flows become instantaneous and AI-driven, does the concept of a human specialist on a physical floor maintain its power, or will regulation need to fundamentally evolve to a purely algorithmic oversight model capable of keeping pace with the technology? That is the structural challenge that lies ahead for every regulator and central banker we discussed today.
A fascinating tension to watch as you navigate your own portfolio and follow the policy decisions of the Federal Reserve and the SEC. Thank you for joining us for this deep dive into how the stock market actually works. We hope you feel thoroughly informed.
Until next time.
Thanks for listening to Smart Money Explained. If you found this episode helpful, follow the show so you don't miss future episodes covering investing, markets, and personal finance. This podcast is for educational purposes only and does not constitute financial advice. We'll see you in the next episode.